Welcome to ETF 360. I'm Tom Lydon here with Dave Nadig from ETF Trends. And we've got a special guest, John Feyerer, who's Senior Director of ETF Product Strategy at Invesco. John, welcome. It's great to have you.
Always good to be with you guys. Thanks for having me.
John, the S&P 500 in the last 10 years just absolutely crushed it. However, it was just a small number of stocks that made up most of the gain. The FANG stocks, Microsoft. Is that a concern at all to investors?
Well, it is interesting when you look at what we've seen just in the last year. You've mentioned the last 10 years, but if you just go back a year, you realize that before the run-up that we've seen, the index was actually historically concentrated. I mean, so often people use the reference of the technology bubble as the time in which the index has been the most concentrated. What's interesting is when you take a look back a year ago, before this most significant run-up, it was already historically concentrated. And what we've seen, really in the last year, it actually far surpasses that to the point now that the top 10 stocks in the S&P 500 are actually all approaching 30% of the index.
Do you think it's different this time? And we all know how the tech bubble ended, and it wasn't particularly pleasant. And it was a lot of rebalancing. A lot of those runaway names came down. A lot of the mid-cap names came up. Would you expect that to happen again?
Well, I do think it's interesting when you look at it. I mean, certainly this go around, the fundamentals of those companies are much stronger than what we saw back at the bursting of the tech bubble.
Meaning some of them have fundamentals.
Yeah, some of them actually have fundamentals. Exactly. It was back then. It was a URL address and a sock puppet, I think. But no, it has changed in that sense. But what's interesting, if you look across history, and you see instances where we see, the concentration really spiking up. And then you just look out 10 years, you end up seeing that those top names inevitably fall off. As a quick note, if you were to take a look at those top 10 names from 1999, flash forward here now, obviously 20 years later, and you actually see that only one of them has continued to be in the top 10. If you take a look at really just what happened even in the ensuing decade, from 1999 through the end of the 2010s, or the end of 2000s, you ended up seeing a situation in which 6 of those actually returned negatively, 2 were acquired, and then the last 2 were in single-digit returns. So it's a pretty consistent theme that you see where you end up seeing those names that are the biggest in the index today don't continue to be so down the road.
Yeah, and historically, there have been periods of time, John, where the smaller constituents, those that were least weighted in the index, actually did much better. And today, you look at the smallest constituent in the S&P 500 is Mattel, and Barbie's coming back. So is there a chance that maybe we're going to see some of these smaller companies pump up their weight a little bit?
Certainly, when you look at the cyclical nature of cap-weighted versus more of an equal weight, you end up seeing that it tends to move in cycles. So it's not surprising. Certainly, as we look out from Invesco's perspective and look out on what we expect resurgence of the economy as we move through what we think is the tail end of the COVID crisis, is just an opportunity where those small and mid companies will have a resurgence where it's more of the cyclicals that'll do better. So certainly, if you look at that versus what we saw last year, which was obviously very narrow market. And one that was led by those mega cap tech companies. So we do think that we're going to see a swing here at some point, and certainly I think some of the signals are pointing to that sooner rather than later.
We'd be remiss if we didn't point out that, you all in Invesco were one of the first folks out there with anything that wasn't market cap weighted. One of those first products was RSP, which kind of solves this problem. It just reweights the S&P and equalizes it so every stock has the same weight. Tell us a little bit about that strategy, how it's done, and where it fits in a portfolio.
Yeah, no, it's interesting. As we talk about this, the term smart beta or alternatively weighted or strategic beta, you pick the name. Obviously, the industry has picked up a couple of different phrases for that. But, in many regards, RSP started that discussion. One of the first strategies to alternatively weight. And of course, it did it with an index that we all know very, very well, the S&P 500. But, what we've seen through time, it's actually interesting. Anytime you have an 18-year track record, it not only provides an opportunity to compare it versus a benchmark such as the S&P 500, but as we often do, it actually compares it relative to a universe of active managers that it's classified against, but even relative to the benchmark. Anytime you have that long of a track record, you can start to look at things like win rates over longer periods of time. And the rolling 10-year win rate over that time horizon is just shy of 90%. So we like to think of RSP as an opportunity for investors to take the concentration out of the S&P 500. So these issues we're talking about here today provides a great tool for investors to be able to, to do exactly that and be able to adjust their portfolio accordingly, so they don't necessarily have that mega cap concentration within their portfolio.
Excellent. RSP, I'll tell you, my wife still has her Barbie camper. Dave, do you still have your Ken dolls?
Oh, come on, Tom. I was more of a G.I. Joe guy. You know that.
Hey, John, thanks so much for being with us and look forward to having you back.